Hi everyone, welcome to Shareplicity Talks. Today I'm very excited to be discussing the whole concept of ESG investing with Emily Flood, Chief Impact Officer at FutureSuper. But before we get started, I just want to remind everybody this is basically not financial advice. This is general in nature. Please do your own homework. We are not providing any recommendations in this YouTube. So, Emily, welcome. Thank you so much for joining Shareplicity Talks.
Thanks, Danielle, and thanks for doing the disclaimer for me.
Well, there will be another one actually on the YouTube as well. Anyway, I thought we'd kick off and just give some of the listeners or viewers an idea about FutureSuper. Could you give us an idea of funds under management and also when it started, the reasons why it started, and also most importantly, what are the way that you like to do your ESG processes, whether it's positive, negative screening?
Absolutely. So one of the fun things about talking about FutureSuper is by telling you why we exist, I can sort of address the rest of it. So FutureSuper started because two people were campaigning for the Greens and they were dissatisfied with how politics was going back in 2014. And so living in a society which is governed both by democracy, but also capitalism, they decided to shift from democracy to capitalism to help create action on climate change. And so FutureSuper exists to create a future free from climate change and inequality. And we use a number of tools to go about that approach, but essentially at the heart of it is the idea that money has power in the world and the decisions we make about it changes the future that we live in, as well as super funds have a fundamental responsibility for the future that their members will retire into. And so we want to think about that not only in terms of their financial well-being, but also in terms of what the actual future will be in terms of the capital that we're investing and the future that that will create. And so when we're thinking about that, that's obviously a trajectory around movements and creating change and how you use capitalism to help deliver those outcomes. So one of the key things that separate us, I think, from big standard established super funds is that it's really baked into our identity, this idea of sustainable investing. So from our investment beliefs to our portfolio quality scorecards, to how we structure our investment team, to how we make decisions at a strategic group level, all of that comes into this idea of building a future free from climate change and inequality and making sure that that's a good future for our members. So that's a really deep difference to the rest of the industry who are already established, have a non-ethical core to their investment strategy and are now trying to release sort of ethical branded products to address an emerging need they see in the market. When it comes to how we differentiate from the rest of the ethical responsible investing space, what makes us different is that the way ESG and ethical investing has evolved, traditionally it's been about aligning how you invest with your personal moral compass. Whereas what FutureSuper is trying to achieve is creating change in the world. And as part of that, you have to be values aligned in terms of agreeing that you want a future free from climate change and inequality and agreeing that those things are problematic. And we have the different tools that we use to help build that future. So there's generally an ethical alignment, but the decisions we're making are about what actually happens in the real world rather than how any particular investment makes us feel. And so I think that's a pretty useful tool when I'm making decisions and when my team's making decisions, because it's a very different way of thinking about whether or not something makes a good investment. But in terms of how we actually make that a reality, we use sort of the full suite of responsible investing strategies. But in particular, we sort of think about things from the idea of using divestment and negative ethical screening to direct capital away from harmful activities. Reinvestment, which is sort of directing capital towards either ethically neutral or positive listed kind of activities, or into impact investments and investments that are creating meaningful material change in the world that is sort of getting us towards a future that is better than what we have today. And then we also think about stewardship as well. So stewardship is sort of how you use your voice as an investor to create change. And that's through things like proxy voting as a equity manager, but also how you engage with companies in your different asset classes and your different fund managers, and using your voice to create that change as well. And we think that you sort of need to have that whole of portfolio perspective, because it's not very meaningful to, say, invest a heap of money into gambling companies that are creating and driving social inequality, and then have one or two tokenistic social impact investments, or investing a heap in fossil fuel companies, but then having like a couple of nice green investments that you can talk to members about. We think you sort of have to think about it holistically and then actually deliver what people are expecting from you and be as transparent as possible so that people can check you're doing what you're saying.
Absolutely. And in terms of funds under management, has it gone well? Is it, because obviously the space has been, growing rapidly, and as you rightly point out, a lot of existing funds have, I think, leapt on ESG, ethical investing, and from a marketing perspective, it's definitely been embraced. So how has FutureSuper gone in terms of that almighty fund management, and how have the portfolios performed? Because a lot of people say, well, they don't really perform as well as other investments, but I'm not so convinced by that.
Yeah, good question. So I think part of what makes us fortunate is our timing for when we entered the market. We're obviously a startup, so we started with zero FUM, and we've sort of taken a predominantly organic growth perspective. So we're straight to members. We don't go through financial advisors or by stapling or anything like that. So none of that regulation has affected us. It's around communicating to members and connecting them to the power of their money. And also to the idea of being part of a movement and creating change, as well as creating their own financial well-being. So we've actually had pretty phenomenal growth because we've sort of been there addressing a hole in the market. Nobody else was fully divested. People are really passionate about creating change and feel like there's not enough opportunity for them to do it using existing tools. So we've predominantly gone through a growth an organic growth focus, but we've also had a recent merger and acquisition with Smart Monday. So between those two factors, we're looking at a trajectory of being over 10 billion funds under management and advice by the end of this year. So we launched back in 2014. So you can see that's a pretty big growth. We're responsible for a significant amount of churn in a number of different funds.
Yeah, that's fantastic. Congratulations. And how have you found the performance? Because I know that there is increasing work done on the performance of ESG funds, ethical funds, and often I've found the overlap between what you might call in the investment industry quality companies and ESG aligned perspectives. Often there are overlaps there, and by definition the portfolios have performed quite well. How's your performance been? Yeah,
it's been really strong. Obviously past performance is an indicator.
Yeah, absolutely.
But one of the fantastic things about when you're putting work into doing really deep qualitative analysis, like what we have to perform as part of our due diligence around delivering on our screens, you do get a really good sense of companies. And the screens that are designed to remove certain kinds of exposures, those exposures carry risk. And that risk often isn't very well priced into the market. So traditionally, high quality or deep green ethical investments deliver very strongly, particularly in down markets. And that sort of over time helps deliver better long-term performance. And you just also are skewed towards certain kinds of industries that are performing quite well historically and recently. So things like tech and healthcare are pretty good from a listed perspective. There's plenty of companies in the world to work with and build well-diversified portfolios anyway. So it's pretty simple from a listed investment management perspective to build strongly diversified portfolios that can track benchmarks. And then from our perspective, where we really like to dig in is in that alts and other investment space, where you can find some amazing unlisted opportunities that deliver great financial returns, but also really positive social and environmental returns. So it's sort of that combination of having a really strong listed strategy that tracks well against a benchmark, and then sort of taking advantage of where your unique strengths lie. Portfolio.
Sorry, really interesting. So you've got a global approach from the listed perspective, in terms of your universe of stocks, broadly speaking, or is it more US focused? Or
we've got a fairly standard SAA across most of our investment options. So we've got domestic equity, we've got global equity, we've got domestic and global fixed interest, and then we've got alts and cash. So our SAAs probably don't look that different. It's what's actually in the portfolios that actually creates the difference.
Interesting. I really like the fact that you've got that diversified approach to the analysis. It's not strictly, positive, negative screening. The fact that you use, your vote via proxy voting, because an interesting argument that I've read about people or commentators that are negative about ESG investing is that for example, in the oil and gas sector, you've seen a lot of pension funds, superannuation funds divesting, and the banks have cut off a lot of capital from these companies. And as a result, some of the assets, if they get capital starved, they go to the private markets, the private equity markets. So it's not actually creating the change that the original purpose of divestment was achieving. It's just shifting it from one space to another. Do you perceive that as being a risk? Is it better, for example, for major investors such as yourselves to become more activist, let's say in a fossil fuel company or in a pulp and paper company, than just pure divestment?
I think creating change takes a number of different strategies. I don't think any one strategy will change the world because it's too complex. But what I do believe is that the fact that companies that are creating harm no longer can operate effectively in a listed space is indicative that there is strain and social and economic drivers that are chasing them towards addressing the harm that they're creating, and that harm is becoming harder and harder to externalize from a financial perspective. As that pressure continues, it's not just a case of, there'll always be private buyers. We will get to points where there is too much regulation risk, there's too much environmental risk to continue to pursue trying to extract value from these activities. It's just not a feasible proposition. People will eventually say, no, there's too much stranded asset risk here. Let's just not say yes. And I think that's a big part of that is the divestment movement and people being loud about excluding companies, because that does create that space and that social awareness and that dialogue that we are seeing start to emerge, and that has been sort of increasing in volume over the past couple of years. But it also takes action from regulators, it takes action from everyday people going on climate strikes, it takes people using their voice in effective ways. But my experience as somebody that works in a company that does have really strict negative screens is that just because you're not necessarily an investor, it doesn't remove your voice. Like, you don't have to be invested in someone to influence their trajectory. And if we're able to protect our members from risks by not investing in something, we shouldn't be making moves to invest in someone because we think that it might slightly increase our ability to influence them, but we have no guarantee. We should be protecting our members from those risks, and we should be using what's in our power to create the pressures that will help change that behaviour.
Fascinating. And tell me, in terms of the demographics of some of your members, are you finding that you're getting it across all different age groups, as well as, or is it more specific to the younger generation? Are women more passionate about this? Because I actually feel that, anyway, there's a long history as to why I think there's a lot of women that are very engaged in this, but that's not obviating that obviously men are very involved as well. But is there any particular trend from your members that you've seen?
We do tend to have younger members. There's probably a couple of factors underlying that. Because we're a choice fund, people have to opt into us. So people that might have had experience with more dated opt-in experiences and the amount of paperwork that influences that process probably have lower appetite to take that action. Generally speaking, the younger generations are much more likely to be impacted by climate change. And so it's a much more material risk for them when they're thinking about their futures. And they're generally much more engaged in the conversations, just as by nature of the sort of social circles. So the other piece of it is that we have quite a high referral rate. And so people will be talking to their friends and their family about us. I think at the moment, our average age is about 35. And we've got a pretty even split between men and women, with a few people that identify as other. So I think that's only about 5%. But in terms of the split, it's pretty even overall if you look at the whole of the fund.
Yeah. And just in terms of the transparency of some of your holdings, I've hopped onto the website and saw a fabulous list. And dare I say, we've got quite a similarity in terms of portfolios, which is a good thing. I'm on track. But maybe worth just highlighting to people that you do have total transparency there in terms of your holdings.
Yeah, we think that that's a really important tool for helping consumers identify and members to identify whether or not the product they're buying is genuine. Because you can say a lot of stuff about how you're screening out things, but if you've got, say, a 20% revenue exclusion, you're going to have a pretty huge exposure of companies that you could invest in that are doing the harmful activity that you say you screen out. So we try and create that transparency because we think it's a really important tool for people to be able to fact check whether or not we're doing what we say. But the other positive thing that we've seen is that finally portfolio holdings disclosure legislation has come in. So all funds are starting to need to report at that level of detail about what's in their portfolios. So it's getting easier and easier for people to look at what actually their funds are invested in and check whether or not it matches what they're expecting.
Yeah, and that's really important. My main criticism of some of the funds out there that tag themselves as ethical or ESG, and a couple of, let's say, whoopsies sneak into the portfolio. And I find that really disappointing, because if it is purely being used as a marketing ploy to gather FUM, then obviously you're undermining the whole purpose of the whole ESG movement. The credibility obviously, goes down. Well, that's really excellent. I guess the other thing I just wanted to touch on is in terms of regulation, because I think that's really, really important. So certain companies can be listed and they have quite high ESG ratings, and it comes through an auditing process. Is that how the system works? And then let's say an investor would say, oh, well, they score highly on that basis. even though maybe the regulation and the screening process hasn't been as robust as, for example, your process may have been.
Yeah,
so I'm referring to companies that might be greenwashing to get their ESG status, but therefore they then slip into those funds that will invest in them.
Yeah, so I think it depends a little bit on the jurisdiction in terms of how things get classified by a regulation perspective. But sort of broadly within the institutional investor community, I think there's a number of data providers that provide ESG scoring. When we started out FutureSuper, we looked into what was on the market and we were pretty unsatisfied with the services, which is why we've got an in-house team responsible for delivering all of our screening. And we work on sort of building out really transparent tools and drawing our lines in the sand as clearly as possible. But a lot of the frustration I have with some of that data is when you take ESG integration sort of at its most basic level, often it's about considering things like how an environmental, a social, or a governance issue impacts the financial future of that company. So a really good example, I can't recall the author or the title of the article, but I'll send it through to you, was on how a company was rated as having a high environmental rating because there was enough water near one of its factories to be able to fund that factory's, to be able to sort of deliver the factory's activities, but it didn't consider at all whether or not there was enough water in that area for the people and the communities living in that location. So it's sort of that issue that's quite significant. And I think relying on high ESG scores without having good look through, which is really important in terms of like how actual ratings come into being, is incredibly important, because you could look at a high ESG rated fund, or you could read a methodology that says we only pick the top ESG rated funds from this data provider, or top rated ESG companies from this data provider. And you might not actually realize that the decision making behind it is actually sort of almost the exact inverse of what you'd expect.
Yeah. It's not easy. I know that Tesla, by way of example, to pick a company that, you know, it's very bifurcated views on the company from an investment perspective, but I happen to stand on the side. Anyone that's been listening to my podcast reads my stuff, reads my books. I use it as an example as a change maker in the world, and the shift to electrifying, you know, vehicles, battery storage, etc. He has been a game changer. But equally, the company has been criticized that some of his governance is not as good because he tweets. There's some question marks around the water supplies, I believe, for the new gigafactory in Berlin. And I think this is where some investors really kind of struggle when you get these contrasting characteristics and how you actually then rate them. There's another example at the moment in Australia, a developer, Lendlease, that is involved in a controversial project, Mount Gilead, with koala habitat, and that's causing a lot of concern as well. Like some of their other work might be towards doing green building standards. So how do you then counteract against, you know, endangered species potentially allegedly having their land cleared? And I think these are very tricky questions sometimes for investors to get their heads around.
Yeah, that's a really brilliant question, and I think it points to a really interesting point of contention within the industry in terms of the different strategies that you can use. But the way I like to think about it in terms of our approach is that there's the question of what a company does just as part of its normal business and how it generates revenue in the world, and how it goes about those activities. And both of those things are valid when you're thinking about whether or not you want to invest in it. So if, as a core part of their business, they are creating harm in the world, either socially or environmentally, then I think it's pretty reasonable to have just lines in the sand where you say, I'm not going to accept investment exposure, because there's nothing that an engagement or governance changes could do that change the core nature of this business.
Mm-hmm.
When it comes to the question of how a company is acting in the world, that's when you can start to think about different strategies. And so for something like, for instance, property development, I tend to think of it as a fairly neutral activity. I mean, there's environmental harm and there's positives as well in terms of the cost of building, but you can sort of address some of those things because the circular economy will start to help. People do need housing. Fundamentally, we need to address the growth in our population and create safe and comfortable housing for everyone. So the core issue there isn't necessarily the core business activities, it's how somebody goes about that business. And so you can have lines in the sand for that as well. So for instance, we have a controversy screen that says, if somebody is doing something, going about something that's neutral or good in a bad enough way, we just won't invest in it. You can also take an engagement first approach. So you can say, we're going to try and work with this company and improve how it goes about its business. And then we will continue to invest in it for that duration and then into the future. But to make that meaningful, I think you need to be able to be willing to walk away from it. Yeah. Because if somebody sort of says, you got to please do this, but there's no consequences if you don't, I think that's, it's a toothless kind of bark. So you need to be able to sort of say, we need to see this change. And if we don't see it, then we're walking away, because that creates a stick and that creates motivation. And I think that that's a really important strategy for all fund managers to have. I know that it's a pretty easy thing to say, like, we're engaging, but I think being able to say, we're engaging, this is what we've achieved is a good thing. And we're engaging, this is what we achieved, but it wasn't good enough, so we walked away.
I think that's a really, really good point. I was given an example the other week, and I won't actually cite the company or the activist who was talking to them, but basically the company promised transitioning to zero emissions, reducing their emissions. And the activist went away and goes, that's great. Well, then a dinner 6 months later, when some alcohol had been consumed, the company goes, oh, well, no, we were just lying. And, you know, it really, I think that's so important that it is absolutely fine for a fund manager, very important to use their sphere of influence. But as you say, at some point enough is enough, and divestment then is the way forward. Yeah, so I think that's really, really interesting, Emily. Anyway, it's a topic that I could just talk about till the cows come home, and it sounds like FutureSuper is doing an amazing, amazing job. I remain very passionate for younger investors to invest to see the future that they want, and it's the only way that change actually takes place. And the world really does need to transition to a space where the money trail can actually make a difference. Yeah. And, you know, Milton Friedman's world of the early 70s, where the shareholders were supreme and it was all just about their returns. I think we have seen quite a dramatic shift now to much broader stakeholder engagement, and realizing that it's not about maximizing the negative externalities to just achieve a bottom line that lines the pockets of the shareholders.
That was beautiful. Thank you for saying that. That was very motivating to hear.
Well, I try and do my bit. It's technically a boomer, which is, you know, I don't like. Anyway, Emily, so maybe just tell viewers, where's the best place to go and check out FutureSuper and all the great work that you have?
So you can either just Google FutureSuper, or it's just www.futuresuper.com.au. That'll get you there. Check out our everything we invest in page, and that's where you'll get to see everything we do.
Fantastic. Well, thank you so much for joining Shareplicity Talks today. I've really, really enjoyed our chat. And I think you are the first female that I've had on Shareplicity Talks. Not that I've had that many of them, but hopefully you're the start of many more.
Thanks, Danielle. It's been really fun chatting.